Hello friends, this is your host Rakesh Kumar again. In the previous video we had discussed about the bullish engulfing candlestick pattern. In the present video we are going to see some examples from the live markets. Before we start the session, I just wanted to remind you that if you have not subscribed to our channel yet, then you can subscribe to it now to get the notifications of the latest video uploads. And if you find this video useful for you, then please consider pressing the like button which is below the video.
But before we begin, let us have a look at the risk disclaimer. It states that the futures, stocks and the options trading involve substantial amount of risk. Your capital is at risk, the losses can exceed the investment. The information is provided as is and the user of the information assumes the entire risk of any use it may make or permit to be made. So let's get started.
Okay friends, the pattern that we are talking about is the bullish engulfing. In the previous video we had seen how to identify this pattern. This pattern particularly represents the upward price movement, and it is a reversal pattern or a continuation pattern depending upon the situation. When I say depending upon the situation, it means I've also explained it in the previous video, but still I want to revise it before we jump onto the charts. That it depends whether the price action is preceded by downtrending candlesticks like black or red candles. There should be at least 4 or 5 red candles before we think this as a reversal pattern. Okay, and also there should be some price action or some key reflex area or key area like support and resistance for the reversal to occur. I'll explain you this with the help of examples, not these examples. Let's move on to the chart because this video is particularly about the chart. Now this is an example of the euro dollar trade. This is the bullish engulfing candle here. I will just zoom it out for you. This is the bullish engulfing. It opened lower the next day following this small red candle here, and you see the range of the day was that it traded lower than the range of the previous day. It closed higher than the high of the previous day. By definition, if we go, then the engulfing candle should have an open which is lower than the close of the previous day, which is true in this case, and it should have a close higher than the open of this. It does not take into account the wicks. Okay, but even if it closes then the higher than the high of the previous day, then it is even more bullish in nature, or you can say it is having more strength in the trend to the upward direction. Second thing, that if the bullish candlestick has a smaller high wick, then it is considered that the day closed by the bulls was at the day's high, and that indicates that the further strength is still there in the bulls to push the prices higher, and that is what is happening here. But I'll say that this candle was not worth trading, although it contains all the things that are necessary for a bullish engulfing candle to form or a bullish engulfing pattern to form, but it lacks one thing from the risk management point of view. I'll explain to you now. You see, we can trade this pattern, but how we will trade this? See, in this one, as we are advised to do, we are supposed to open a position at the break of this high. Okay, and we are supposed to keep a stop loss which will be below this candle. But the question is that where should be our target? Now from here, I understand, because we have not seen the market ahead, so we are only able to see what is there behind. So from here, if this is my current candle, then looking at the back, this is going to be my immediate resistance, and this was the support. Okay, the price action is happening at the support. Okay, I will buy it, but what is the probable target? So if the probable target is this area, which in this case would be approximately 362 points, but my stop loss is approximately 165 points, so it gives me less than 1:3 risk to reward ratio. You can clearly see that this one was 16 3s are 48. I must have 480 points minimum to take this trade. Of course I can trade this now also, but if I take trades like this, then I will be not profitable in the longer run if I have less than 50% success ratio. Now that I can explain to you in the videos on the risk management or the money management, but for here you can simply say that if my stop loss is here 166 points, then I must have a take profit at least 166 multiplied by 3 potential profit. Not, I will not blindly keep the target there. Okay, I'll keep the target based on the previous price action, and it says that this is a resistance zone. So if this is going to be my potential target, then there is no possibility that I'll get a 1:3 risk to reward ratio, so I'll just skip this trade. But on the other hand, if I go and see this one here, this is also a bullish engulfing candle here forming, and that is also forming at the this support area, and here you see it also qualifies everything. It has it has occurred after a downtrend, and then it has a lower opening and higher closing. The preceding candle is very small. And what is the stop loss here in this case? In this case, friends, if we say we open the trade here and we keep the stop loss here, and if you want to counter this long red candle also, you can also keep a stop loss here. What will be your stop loss here in this case? If you open the position at this place, then your stop loss is going to be approximately 60 points, and you have a take profit target of 6 3s are 18. 180 points should be your take profit target. From here, if I take 180 points, so it is well within the range of the previous high. So I will definitely take this trade where my risk is small and my potential take profit targets are huge. Okay, I am not saying that you be greedy and keep the trade running, but you should at least be able to take 3 times of what you are risking here. Okay, that was one example. The another example is in the pound, is in cable. In cable you see that this particular is worth trading. Now why I'm saying that this is worth trading, you see, because based on the daily chart, these were the potential support and resistances. I'll just mark. I'm not blindly marking. I have already told you how to place support and resistances on the chart, which we have explained in the previous videos, and you must go through them in case you are not aware. And okay, this is also one sort of support. So the price was making higher highs and higher lows in the long run here, but here there was a pullback from the resistance. This is a zone of resistance. See, there was a pullback, and this pullback stopped at this resistance, which I think is trying to become a support now. You see, this area which was support previously and resistance here and also here is trying to become a support. Now if the price action is giving me a bullish engulfing candle in this region, I will definitely go and buy. But what are the possible targets? The possible targets are this one, this particular 1.9058. Why? Because it has been a resistance in the past. It has been a resistance in the past. But in this case, I have very small stop loss. Very small stop loss. Approximately this is my take profit, and if not this, then if it breaks out of this one, of course, then this is going to be my next take profit target. And if I am going with the trend, which is higher highs and higher lows, and also there is a pattern forming here, which is in the form of you can say what it is called, inverse head and shoulder. Now you will say, where is inverse head and shoulder? We have already discussed everything like this. This is left shoulder, this is head, and this is another shoulder. So from here we have learned that if we join a ray using first and second low, then we get a neckline. So this is going to be my next level of resistance. So this is going to be my next level of resistance. If I am opening a position, at the high of this candle and I'm keeping a stop loss below the low of this candle, then my possible risk here will be 140 pips, and I must need 520 pips. sorry, 420 pips. So this was approximate target. It was achieved, but the resistance zone came into play. So if you want to take this trade, seeing that stop losses are less and the probability of win is more, what we can do here is that we can open the trade and we can trail our stop loss as the trade proceeds higher. This is one, or otherwise you can just drop this trade also, seeing that my risk to reward is not 1:3. If you just follow this simple rule of thumb that if I do not find 1:3 risk to reward ratio, then you will be definitely be consistently profitable in the long run. Even if you go 50 times, 50% of the times, if you're right in planning your trades, then also you will be profitable at the end of the day. So this is not worth taking. If you have probability of finding bullish engulfing which is not near the resistance, then only it is a good trade. Okay, not worth it. Now this one is possible, I think. If you see here, I have marked a bullish engulfing, and the next or the immediate resistance is at this level. I'll just make it in the form of a rectangle so that it is visible, and you see that it is forming nearly at the support region. So we will try and see if it qualifies for our money or not. Here we are going to open the buy. Here we are going to keep stop loss. If we consider the previous lows also, then maybe here we will keep somewhere here, we will keep our stop loss, and we open the measurement. From the measurement we come to know that from buy till low we have 70 points, 71 odd points of stop loss, 70 to 21, 210 points must be this line away, then only we will open this trade. So this is more than 210 points, it is 230 points. So this is going to be a very good trade. We should buy at this, buy stop buy and stop loss here and take profit target at 210 points. Fair enough, it is very easy and very good rewarding trade. We should be looking for such trades where there is a possibility of finding at least 3 times whatever we are going to risk. Friends, this is simple mathematics. I just want to do in front of you once again, and I always want to do it. You see, if you say you take 1:3 risk to reward ratio, that means if you are risking 50 pips, you are going to make you are going to lose $500 if you are taking a standard lot. Okay, so your risk is 500 each time, I am saying, and if your reward is say 3 times, then your reward is, I just cannot stress it more, then your reward is 1500. Why? Because you are risking 500 and your reward, what you are seeking is 1500, and it all depends upon the support and resistance. You are just not randomly selecting 1:3. You are seeing that if it is there, then only you will open the position. If it is not 1:3, then you are not going to open the position. Then what is going to happen? Say it happens for 10 trades. Out of 10 trades, you win only 5 trades. If you win 5 trades, that means 1500 into 5 is equal to 7500, right? So you are going to win 7500 if you win. And what are you going to lose? Because you have lost 5 times. So what are you going to lose? You are going to lose 5 5s are 2500. So you see, 5 times you lost, 5 times you won. 5 times when you lost, you lost 5 into 5, 2500, and because you were targeting 1500, so 5 times you got it and you got 7500. And you can do the simple mathematics. It is simple mathematics. After this, you still get 5000 in your pocket. After 10 trades, you get 5000 in your pocket. It is not bad. Yes, it is not bad. But what did you do? Did you do some good trades? No, you just kept in mind that whatever you are risking or whatever you are looking for as a reward should be at least 3 times whatever you are risking. That is the whole story behind this. But also you have to see that the trade justifies this area, because in this trade in the GBPUSD, this did not you did not have a potential of 1:3. That's why we just did not take this trade. Or you have to stop yourself, because when you see a bullish engulfing candle, your intention will be to just go and grab this trade. You will have a fear of missing out, that if I will not take this trade, maybe I will just lose. No, you don't have to enter a trade unless you see that the resistance is at least 3 times whatever I am keeping my stop loss at. That is the one thing. Now we'll see another example of the EURUSD. Now this is another example. I think this is the last one that I have pulled out. So you see that the preceding 4 candles, in fact 6 candles are red. So we are expecting an upward thrust here. This particular candle here, this was a bullish engulfing candle and it formed at the support. Now this is not the only support, but also see that previously also there was a support at this region. That is why I am saying that this particular bullish engulfing is worth trading. Not only this one, I will say that even this one is worth trading. But in this case, I will say why did not I now you can also clearly say why I did not trade this one, because here you see the resistance was very close, or you can say it did not give me 1:3 risk to reward. I'll just prove it to you now. Our buy order was here, our stop loss was somewhere here, and if we measure the move from here, it is 66 pips was our stop loss, and 180 pips we wanted, and it did not justify. I do not want to take 1:2, I want to take 1:3. That is the rule of the thumb, because I want to be consistent in the long run. But in this case here, if you see, if say we have opened position somewhere here and our stop loss is okay, we consider this candle also, because it has made a significant low here. 77 point, or you can say 80 point is our stop loss, and we are expecting 240 points, and the next level of resistance after this price action is becoming this one. This is going to be my next resistance. So this is where I will be expecting to book the profits. So from the buying, I want to see 240 pips, but it is giving me approximately 423 pips. So I will definitely go and buy this. See, my stop loss is going to be 80, I need 240, and it is giving me even more. So I'll be very happy to take this trade. So this is how you are going to take the trades. Now I cannot stress it more. Please bear in mind that opening the trades are easier than managing them. Before you open a trade, you have to plan that it should give you at least 3 times. If you see that there is a resistance coming in between and it will not be able to give you 3 times whatever you are risking, then do not open the trade. I will also request you that you learn proper risk management before entering any trade, and you should not lose more than 1% whatever you are risking. I mean, if your stop loss is say 50 points, then if your stop loss gets triggered, then you should not lose more than 1% of your capital, so that you can survive the market for the next day of trading. And this can only, and also just enter a trade if you get 1:3 risk to reward ratio. Otherwise don't enter a trade. With this note, I will end this video. We'll see you in the next video. Thank you very much for watching.